Hey, this is Jason with Two Sides of Phi. Today I'm talking with Karsten Jeske, who has a PhD in economics and a CFA, and is perhaps best known as the creator of the Early Retirement Now blog. And he has written extensively on safe withdrawal rates, something Eric and I have talked with him about here on the show. Now, in this episode, I'm talking about options trading with him and how Karsten has used a specific strategy to generate nearly $1 million in revenue with only minutes a day of effort. And I know that that sounds too good to be true, but I've been paper trading this strategy for several weeks now, and you'll see that there is merit to this idea. Now, if you're new to options, there's going to be some terminology here you'll want to understand better. Go to the show notes at twosidesofphi.com/options for all those details, as well as links to the relevant blog posts that Karsten has written that will give you even further background than what we talk about here today. Thanks. Welcome back to the show, Karsten. It's really great to have you here, and especially given that I know you're taking time when you're abroad.
Yeah, thanks. Thanks for having me on the show again.
It's our pleasure. So maybe at a high level, what does this strategy involve that you're trading on the SPX?
Right. So, first of all, the big picture is, getting a little bit of extra return, right, is immensely useful. So imagine that you could just increase your expected return by maybe just a percentage point, right, during your accumulation phase, right? So you could either reach your goal faster, or you could build a bigger nest egg. And then in retirement, so suppose you could increase your safe withdrawal rate from 4% to 5%, right? It's not a 1% increase, it's a 25% increase in your retirement budget. So that's a hugely important and hugely useful. And you can't really do that with anything else, right? I mean, you can't stock pick your way to an extra 1% return. Maybe some people try, and maybe they got lucky, right? And they bought NVIDIA and Tesla at the right time, or they sold Tesla at the right time and then bought NVIDIA. But for the most part, we are not good at stock picking.
Right.
So the nice thing is that this is a strategy that you can do on top of an existing portfolio, and you don't really have to sell any of your existing assets, and then you just simply use your existing assets and squeeze out a little bit of extra return. So what I'm doing is I'm selling options on the S&P 500. People have tried different underlying indexes, but the S&P 500 index options are obviously the most liquid ones. So I'm selling options, and the idea here is the people that buy options, right? So there are put options and call options. People who buy put options are people that want to buy downside insurance. People who buy call options are people who basically want to have this lottery-style payoff, right? They want to have the potential for some really big payoff on the upside, but also have very limited downside. You have a relatively small wager, but then also a very sweet payoff if the market actually rallies. And there's been a lot of research done, and both of these buyers of options are really just doing a sucker bet, right? So people are overpaying both for the downside insurance, and they're also overpaying for this lottery-style payoff. And so it's actually more. It's a little bit like the people are in the casino, right? Who do you want to be in the casino? You want to be the casino, not the player. Right. So a little bit like that is going on in the options market too. So people tend to overpay for options. And so the right thing to do then is to sell the options and serve this market and basically provide liquidity and provide a supply of options that people apparently demand. And doing that is just like in the casino, right? So you make every once in a while you pay out a large sum, but you hope and cross your fingers that over time the good days outweigh the bad days, and this is, at least in my experience, and I've been doing this since 2011. It has always worked out. Certainly every single calendar year I've made money with this strategy. But obviously there's some bad days and bad weeks. Sure. I think the worst return was that I potentially wiped out maybe 2 months of option premiums, and it took me 2 months to dig out of that hole. But I mean most of the time you have a pretty consistent and reliable payoff from that.
Right.
It's not every month, but it's certainly averaging out over calendar years.
Right. So Karsten, I think one of the things that I'd like to get out there kind of early is that once you have this in place, this is relatively quick and can be traded from almost anywhere. And so
Right.
this, you talk about this idea of, how much you can earn as an hourly rate. Can you give me some sense of what it actually takes, in terms of your effort to trade this and what the return on that has been in the previous year?
Right. So I've made close to $1 million trading this strategy.
Wow.
And so actually just purely the trading part is not really the time constraint, right? I mean, you could do a few trades. I mean, I always joke I've traded this on a ski lift, right? So I've traded my daily trading requirement on one ski lift ride, right? Which is something like 3 minutes to 4 minutes. Yeah, so I mean, my plan is to make somewhere around maybe $80,000 a year extra with this kind of strategy. And so it takes me a few minutes in the morning, a few minutes in the afternoon.
This is something I can vouch for. I've been paper trading the strategy for about 3 weeks now. And once I got into the kind of routine of things, I find for me it's about 10 minutes at market open, to put the stop orders in for the 1 DTEs from the previous day and the new 0 DTEs. And at the end of the day, kind of same thing, 10 minutes at most. It's a nice idea for somebody who's retired and doesn't really mind that little commitment if you're in front of the computer in the morning for a little while anyway, or on your phone, because it's certainly easy enough to trade remotely. I've done it from the passenger seat when we were on a road trip. It is pretty fast. So I think that element of it is certainly very true. Maybe a good place to go from here is just describe the particulars of the strategy and what it looks like to execute. And there's a lot to that. Right. So maybe just start at kind of first principles and we can go from there.
So my philosophy is that I would like to have as much diversification over time as possible. So what that means is I want to sell the put options with the shortest possible expiration time. So the shortest possible expiration time has only recently, I think in 2022, became 1 day, because we used to have, way back, we used to have only 1 monthly expiration for options every third Friday of the month. Then it became every Friday of the month. And then they added the Monday and the Wednesday expiration. And then in 2022, we now have expiration every single trading day of the week. And then there's even a special situation where we have 6 expirations during the third Friday. If we have the third Friday of the month, there's a morning Friday and an afternoon Friday expiration. So you have actually 6 expiration times that week, Monday through Thursday, and then 2 on Friday. So my philosophy there is that I would like to have as little correlation between different option contracts. So because some people say I'm writing options something like 60 days out, right? And then they do 60 days out, and then they wait another week, and then they do another 60 days out. The problem with that is that you have a lot of overlapping contracts. So if you have a particularly bad day in between, potentially all of your contracts go sour. Whereas I like to have as many different independent bets as possible. So just like in the casino, right? The more people play, and you have independent plays like a roulette wheel or a blackjack table. So the more independent bets you have, if the odds are in your favor, I prefer to have as many independent bets as possible. So I prefer to have 1 day to expiration and 0 day to expiration contracts. So I'm selling end of the trading day for the next trading day. and in the morning for the current trading day.
You're talking about the last 15 minutes, and then after the market closes, there's a window of time. What is carrying out those 1 DTE puts look like?
Right. So ideally, I would like to do all my trades before the New York Stock Exchange close.
Right.
Which is 4 p.m. on the East Coast, 1 p.m. On the West Coast. One little constraint, right, and that's margin. Right. Yes. So imagine you have a lot of contracts that are expiring that time. My margin is maxed out, and I have to wait until a few minutes. Sometimes it's as little as 20 seconds. Sometimes it's as much as maybe a minute or a minute and a half until the margin comes back. So because the current day contracts, they expire, the margin comes back within maybe anywhere between 20 and 90 seconds. And then I have to trade the new contracts for the next day, a little bit after the New York Stock Exchange market close, which is no problem because the options market trades for another 15 minutes after the NYSE market close. So, I mean, it's definitely the first 5 minutes after market close, there's still a lot of activity and a lot of liquidity and activity that you should still be able to trade everything you need to trade for that day.
Right. Now, margin is a topic worth getting into because that is an important element of this because of the potential downside risk, and we'll get to stop orders later. You are required to carry a certain amount of margin by your broker, right, and then you, in addition, carry beyond that. Can you talk a little bit about the margin constraints on the 1 DTE trades?
Right. So you have to have enough margin and underlying capital. Otherwise, the exchange will not allow you to short a contract, right? Because if for some reason the option goes in the money and for some reason you don't have the money, right, it's basically the exchange is on the hook. Because the option buyer will demand that money. If I can't come up with it, the exchange would actually have to come up with it. So, for example, to sell a put option, you need to have somewhere around between $50,000 to $55,000 in margin in your account, and so basically take your account value, you divide it by about $55,000. So that's the total maximum number of put options that you can short. And then obviously, depending on what the strike price is and how many days, there could be some variation. So puts that are further out of the money require maybe a little bit less margin, but not much less. So sometimes it's, even so right now S&P 500 is at 5,500 points. Even the 5,000 strike or the 4,800 strike for a 1 day put, right? What are the odds that the market drops by 500 points or 700 points? So it's quite remote. So even those puts require almost as much margin as a put very close to the money. So so you need to have some underlying capital, and you have to show that you have that. And if you don't, you can trade. And again, it goes back to the question: when can I trade these? If I'm already maxed out and I have zero additional money left over to sell, I have to wait until the options expire to sell more. So that's a little bit of a constraint. So usually what I do is I have my options expiring that day. I may have a little bit of extra capacity, so I already trade maybe a third or a half of the puts for the next day, and then the remaining ones I have to wait until maybe 1 minute after market close, after New York Stock Exchange market close.
Okay, so a natural question is then for these 1 DTE put contracts, how are you choosing your strike prices, and how does that translate to a percent out of the money or delta or other metrics people might be thinking about as they hear this?
Right. So a lot of people, they target something like a fixed delta. I don't. Yeah. And so the question is, do I ever want to automate this, right? So write some kind of a computer program and completely automate that. It's going to be hard because I definitely like to see the entire list of strikes and see where's the sweet spot and that changes. So obviously I want to make something like at least 10 cents premium on the put. But I also want to be a certain percentage out of the money. But then out of the money percentage, it's also relative, right? So something like 4% out of the money right now is really seems to be relatively safe. In March 2020, 4% out of the money was nothing, right? You could have sold for relatively rich premium something like 15%, 20% out of the money. So that's also basically guided by where the market is, what's the implied volatility, how much are people willing to pay for insurance right now.
Right. So I know that, and certainly the particulars of it are part of your approach to this, but you're making some sort of risk-based assessment to help guide where you should be picking strikes.
Right.
So
in that sense, I mean, the market is your guide, right? So in that sense, the market is efficient in that sense. I think, again, as I said before, I think I have an edge and I make money on average with every contract. But then there's obviously how far you sell out of money depends on where we are in the market cycle, right? And then, by the way, even in relatively calm market, right? If there's an FOMC meeting that day, right, and everybody is wondering, and especially an FOMC meeting where there's a little bit of uncertainty about what might come out of it. Is there any announcement about either a Fed rate cut that meeting or signaling a rate cut at a future meeting? So that's usually a very volatile day, and you can already sense that. You can already see that the day before, how far you can sell out of the money. And other important dates would be CPI releases, payroll employment releases, PC inflation releases. So that's and the market prices that in properly. But again, I still make an edge on every contract. But you can definitely see that the out of moneyness that changes from day to day and from week to week. That's for sure.
Now, one of the things I've seen you mention on your blog, and it'd be good to hear if your advice has changed on this. And obviously, we are not telling anyone how to invest here. Everybody should do their own assessment and do what makes sense for them. But if somebody doesn't have a more sophisticated risk model, and yes, they're using market conditions like we all should to determine what to do, is targeting something like a fixed amount of premium a reasonable place to start in looking at a strategy like this?
Yeah, I think so. I think that's what I did. I have some models. I run some Python program every morning, and gives me some guidance on where my strikes should be. But something like a fixed premium. And so obviously, so say everything fixed premium that gives you a certain range, and then a certain percentage out of the money. What was the worst one-day move over the last 3 to 4 weeks, right? That gives you some guidance. So I think target a premium, and I think that's the first that would be the first thing I would try.
I'm sure that somebody watching this who has a little bit even of options experience is saying put writing is great for income, but when you're talking about this type of trade where you're selling naked puts against the SPX, the analogy always comes up of picking up pennies in front of a steamroller, because the premium you're going to receive is known and is relatively small, but the potential downside risk is very high. So why isn't it picking up pennies in front of a steamroller?
In some way it is, right? So the question is, how big is the damage if the steamroller gets to you? Well, right. In the case of the steamroller, you might be dead if the steamroller runs over you. So maybe the steamroller is not really a good analogy. So I think that as long as in expected terms you do better. So I think that we're literally selling insurance, right? And just like in the insurance business, There are sometimes some very severe payouts, but the premiums you collect from all of your insured population should more than cover all of those payouts. Everywhere you go, right, you see selling insurance is an extremely profitable business. Now, there's one crucial difference between insurance, the way I sell it, and insurance, say, the way Geico sells it, right? They average over a lot of people. And so pretty much every year they should make a profit, whereas I sell and I diversify over each single trading day, right? So I have a little bit less diversification than Geico, because you would think that Geico every single year and every single day they collect more premium that they pay out. Maybe there's a big a thunderstorm or a hurricane where homeowners insurance kicks in. You might get a little bit of that, but so obviously I certainly have more bad days than Geico potentially. So but in the spectrum between steamroller and selling insurance like an insurance company, I'm definitely much closer to the insurance company than that steamroller example.
Okay, perfect. And one of the posts I'll link to in the show notes is you went back and looked at the worst one-day drops and then those within a few percent range, and then looked at what the VIX was, the volatility index, the day prior when you'd be making these decisions. And I think that's a very informative way to look at how assessments of market volatility could potentially guide someone to think about how far out of the money to be.
Right. Because this is really the common question, right? Where people say that, so you imagine you do something like maybe a 3 times leverage, right? Where you sell puts and you calculate, well, what is the notional of your basically what's your strike price, and then your total exposure is what if below that strike the index goes down to 0, right? This is the maximum you could lose, and you look at what if the market went to 0, how much would you lose as a multiple of your account value, right? So this is the way I calculate leverage.
Right. No, that makes sense.
And so that could be somewhere in the region. It could be as low as 2. It could be as high as 5. And then somebody says, "Oh my goodness, what if we have a repeat of that day in, I think, October 1987, right, where the market dropped by 21%, right? Oh, you have 5x leverage, and the market goes down by 21%. Yeah, okay. I mean, you're not paying out the 21%, right? It's the 21%." Maybe you have 5% up to your strike, but you still drop 16%. Well, times 5, would you lose 80% of your account value? I said, well, that's not really a fair comparison, right? Because in 1987, you had already this little bit of a volatility cluster, right? So there was already a lot of volatility the day before, so it's in my personal view, it would be highly unlikely that we have another 21% drop tomorrow, right? So. So usually all of the big drops, and even in a relatively fast-moving bear market like March 2020, the volatility builds, right? And then you don't have these really big moves completely out of left field. Usually volatility already builds up. This was the case in 2020, during the global financial crisis too. So when Lehman Brothers failed, right, there was already extreme market uncertainty building up for actually more than a year, right? It was in September 2008. I think even in March 2007, there was already some rumblings. And I mean, in August 2007, some really bad news in finance. So it's building up. And so the probability that you have something like 10% or greater loss in the stock market in one day is extremely highly correlated with how the volatility, the implied volatility was the day before. So that's a given.
Thinking about those one-day drops, whether you can see them coming or not, I know that one thing that did change over the course of your blog posts on your option strategy is the use of stop orders. And their use with options is always a controversial topic among the options community, but typically that's about longer DTE strategies. So can you explain why you decided to start implementing them, and how are you using stop orders these days?
Yeah, so I have evolved on this issue. So I think in the beginning, I never used stops. And I said, well, if something goes in the money, it just goes in the money. You take a loss and you move on. And most of the time I was actually right, where, the market drops at the open and it looks like, it's going to be a really bad day. And you just sit it out, and in the end, you had what I always call it a point landing, where the index comes in maybe 5 points above my my highest strike price, and so I've done that for a while. I'm now doing stop orders on all my puts, so both the overnight and the intraday, and the reason is so twofold. Actually, this year I have used stops. I think the stops got triggered 9 times, and 8 times the stop loss lost me money because the market then recovered. And in fact, the market never even got close to the strike, right? So, for example, if within the first hour of trading, the market drops by 1% or 1.5%, you already get, even though you don't even hit the strike, just the time value of the option is so high that it knocked out my my stop. And so market never even got close to my strike, and I still got stopped out and I lost money. And it was about 8 times this year. But that 1/9 time, the stop executed, and it saved me more money than I lost with the other 8. So this year it was actually, and so I also track that. So I track, and I call that what is my active return from the stop orders, right? So I compare what if I had just sat on my hands, do nothing. And so this year I would have not lost anything on those 8 different days. But on the 9th day, I would have lost so much that it compensated for everything. But then in other years, I actually lost money net with the stops. So I must say it was a little bit stressful sometimes when I was doing this without the stop orders, right? So for example, imagine you sell something for 25 cents, and then you put a stop loss at, say, $2. And then the stop loss, and then the quote of that option goes to about $2, which is not a lot of money, right? It's $175, but it's per one contract. So you multiply that by several contracts. So you could very easily get into, maybe multiple times your food budget for that month. And then now you are at 2, and you say, well, you know what? I'm just going to let this run because I'm not even close to the strike, right? So it's that $2 is not intrinsic value of the option. It's just pure time value, especially if the drop happens early during the day. But then the question is, when do you pull the plug, right? What if the market keeps deteriorating and it goes from $2 to $5 to $10 to $12 to $15? And now you do the math and you say, wow, I've lost so much money now that this has wiped out multiple months of option premium. And so I think it's rational to just pull the plug at a fixed amount, whether it's $1.50 or $2 or $2.50. You have occasional losses, and it might actually be. I mean, this year we have already had 9 losses, but they were all for the 0 days to expiration. I think 5 times on the put side and 4 times on the call side, and so it's more than 1 a month. But we still made a ton of money on the strategy overall, and I'd rather have it this way than. be right most of the time, and then just one bad trade just wipes out your entire
Yes.
year's work there. So that's why we settled on these stop losses.
Okay, a few questions that naturally come from that. I'll give you the easier one first. I'll give you both of them. The easier one is for those 1 DTE puts. Are you setting those and letting them run overnight, the stop orders, or are you setting a stop order at the start of the next trading day?
Right. So I set the stop at the start of the next trading day, which has the little bit of the risk, right? What if the gap down the next morning is so bad that it's already above the stop? So that's a concern. It has never materialized for as long as we've been using stop. So because we're selling really far out, and then the stop would also be high enough that it would have to be a really substantial, something like a 5 or 6 standard deviation down move overnight.
Right.
It has never materialized. It came close a few times, but it never materialized. So that's it's a concern. Is on my radar screen. What would we do is say we have a stop of 5, and then the open the next morning as well. The option is already at 12. So in that case, we would buy it back at 12 and just lick our wounds there.
Yes, and I know there's some secret sauce involved in this topic as well. But how should or how can people think about setting stop loss prices? Because of course here we are doing it, as you've alluded to, on the option itself. It's not on the underlying. Right. So how should they think about stop loss prices?
Right. So make up your mind. How much are you willing to lose on the stop as a multiple of a day's premium? Right. So in that sense, if you lose on the stop maybe 10 days worth of option premium income. So right now, on the overnight, we have never had a loss. On the put option, we've had 5 out of 7 months. So in that sense, we still made more money than we lost with the stops. That's the way I would think about the sizing. How many times daily option income are you willing to forego in the stop loss?
Right. And one of the ideas I've seen come up to readers of your blog is this idea of 2 weeks to 2 months, something in there is a range in which people might consider looking.
Right. That's what I would recommend. Yeah.
Okay, let's transition from those 1 DT puts to 0 day, so same day puts, and then also calls you just mentioned, so great transition. You introduced those at some point. Tell me about the role of those and how you think about those, either similarly or differently from the 1 day to expiration puts.
Right. So my philosophy was that so I sell the 1 DTE puts, and I would not sell everything that I have as margin. So because there's, especially if you use interactive brokers, there is this dreaded exposure fee. Yes. I don't know if you've encountered that. Mm-hmm. So basically at interactive brokers, you can be completely within margin requirements for the exchange, but interactive broker still hits you with this exposure fee, which is so their own risk model determines, well, what if we have a overnight drop of 30% of everything, right? So what would happen, and would you have any exposure in the sense that it would wipe out your account, and would there be any losses left over that somebody has to cover? In that case, probably interactive brokers and or the exchange. So they charge you an additional fee, form of an exposure fee. So that kind of sort of eats into your option premiums. So I want to avoid that. So it's basically overnight. I sell only as much as I can get away with in terms of this exposure fee math. And the nice thing is, for intraday options, there is no exposure fee.
Got it.
So they only calculate the exposure fee for the overnight contracts. Then what you do intraday, because everything has expired by the end of the day when they calculate this exposure fee. So, so I always thought that, well, this is a nice way of getting a little bit of, basically supplemental income, and in the sense that most of the premium you make from selling the 1 DTE puts really comes from overnight, right? So from 1 p.m. West Coast time to 6:30 a.m. Market open, basically you lose. The buyer of the option loses the entire premium almost, and there's really nothing left in terms of premium. So that means I have both. So basically, just from the delta exposure for the option, and then also in terms of margin money, I have something left over, right? And anything that makes money on average, right? If I don't trade anything, I leave money on the table.
Right.
So I would like to max out these intraday options, and so basically I will then at the open sell as many puts as I can get away with. Now there would be one exception where if the market is down so much that my 1 DTE options are at risk of going in the money, then I'll probably take a step back and maybe watch what happens. But if it's a normal day, and this is 99% of the time, I will definitely max out the intraday puts, so the 0 DTEs. And so that's where that idea came from. It would be more efficient to do everything as 1 DTE because premiums are richer and you can be further out of the money. But just the way this exposure fee math works out, I prefer to do the split it into 1 DTE and 0 DTE options.
I got it. No, that makes perfect sense. So if someone were at a different brokerage that didn't have exposure fees, right?
Didn't
1
have
DTE
that.
could be the whole strategy.
Yeah, maybe you just do the whole one DTE. Yeah.
Okay. How did the call selling get introduced into it? Obviously, as you just mentioned, it's a part of this.
Right. And it's a good question. People have been bugging me about this for the longest time, and I always said, I find it unpatriotic to bet against the market, but it's totally irrational to not do the call options, right?
Yeah.
And so far I don't do the call options overnight, because there's not really that much premium for the 1 DTE, but I do the 0 DTEs. The nice thing about the 0 DTE call options is that it doesn't mess with my margin. So for example, you imagine you max out all of your put option margin pool, right? So you can no longer sell any more puts. But you can sell more call options. So the nice thing is, obviously interactive brokers and the exchanges and everybody, they're pretty smart, right? They say, well, the two risks are negatively correlated.
Yes.
So you should be able to sell more call options even if you have maxed out your put option pool. So that's the first thing that struck me. Yeah, maybe I should sell the call options because there's actually some money to be made.
Yeah.
I must also say that, and again, I don't have enough data to support this, but so in terms of the premium capture rate, this is what I call how much money do I keep as a net premium after I pay out all the expenses for the stop losses. The premium capture rate was actually higher for the call options than for the put options for as long as I've traded them. So in some sense, the call options are pretty good business. And then the other thing is that it took me. No, I knew about it, but it took me a while to pull the trigger on that. That obviously, if you lose money on the calls, right, it means that the market rallied.
Right.
So it means that I have so much equity exposure in all my other accounts and my retirement accounts in the underlying assets that I have at Interactive Brokers. If I lose $1,000 or $2,000 on the stop loss on the call, well, I would have made $10,000
exactly
if the market rallied just in the Interactive Brokers and maybe another 5-digit sum in all my other accounts. So why do I worry about losing money on a stop loss on the call options?
Right.
So finally I relented. I think late last year, I think fourth quarter last year, I finally started the call options. But I mean, it is true that obviously you don't go as far out of the money on the call side, right? Because the upside volatility seems to be a little bit less. I mean, that's just the skewedness of the market, right? You have more potential for downside big movements than on the upside. Yes. So sometimes it feels a little bit scary, right? So you imagine right now market is at 5,500 points. So sometimes you sell maybe on the put side 100 points out of the money, and on the call side maybe only 65 to 70 points out of the money. Feels a little bit scary, but I mean the numbers don't lie. It's definitely I've made more money on the call side than on the put side. So right. It's just a little bit of extra money. It's not really a big money-making business. It's really the bread and butter business is still the one DTE puts. So
right. Now you bring up an interesting point about the equity gains in your collateral, which is your true buy and hold portfolio. So does that mean that given that theoretically lower risk, because sizing is always a question, right? How do you think about the volume of those calls to sell? They are at lower premiums typically, but
right. So I sell less calls than the 0 DTE and 1 DTE puts combined.
Got it.
But I mean it's up there. It's maybe 2/3 of the put volume.
Okay.
And so I've seen cases where I've sold so many calls that actually now the margin constraint was more on the call side, and I noticed that when I then sold puts for the next day.
Yeah.
Right before market close. Oh, it didn't even impact my margin much because it's actually the call side was the constraining side. But I mean, normally it's the put side that's the constraint.
Got it. Something that I didn't ask when we were talking about stops is if you do get stopped out, there's still opportunity on the table. Are you selling additional puts at lower strikes when you get stopped out?
Yes. Yeah, I usually try to do that. In fact, not doing that is really leaving money on the table, right? So because that's usually that's a good time to go in again, and as market is pricing, the market is demanding a lot of premium for that volatility, and so I try to do that if I get stopped out, just go in right away and at least recover a little bit of the loss.
Right. A different question on risk. So, you can have, I think there's tons of merit to this idea of keeping emotions out of trading. Right. We need to be systematic, and you do an excellent job of conveying that, and not a surprise given your background that would be precisely how you would trade and have a rule set to follow. But there is still the reality, and one of the things I can imagine somebody saying when they're thinking about this is, it's all well and good to set stop orders, but there's no guarantee they execute at that price because, of course, a stop turns into a market order, and if it gaps way past it. But, so I guess what I'm asking is, in the years you have been trading this, how has that actually gone? Have you had big gaps down and resulted in much more substantial losses due to the way a stop executed, or what has that looked like?
I mean, obviously, so if I set a stop at, say, 150, I mean, usually then it executes at 160, right? So that, because it needs to wait until it hits that stop. So there's no guarantee how far it will fall. So obviously the concern would be some sort of a flash crash.
Right.
And so in all the years I've been doing this, so I've actually never experienced a true flash crash. The latest true flash crash was in 2010, which is a year before I started this strategy. And I mean, obviously we had a lot of volatility, especially intraday in March 2020. That was the last time. But I mean, the nice thing was that in 2020 in March, I had sold so far out of the money puts that even that intraday volatility didn't really ding my returns. Actually, March 2020 was the best single month ever for the strategy. So. So I agree. So it's in the back of my mind that what happens if there is something like a fat finger mistake. Again, I think the one, I think it was in May 2010 that was a fat finger mistake where somebody sent out the wrong order, I mean. It's on my radar screen, but I still prefer to have a rules-based approach to losses, and I'm willing to take that risk. So
yeah. It'll be an interesting transition moving from paper trading this to trading for real for me. And I actually don't know. I think I may start with a smaller position because, of course, in paper trading, I'm trading right up to the margin limit all the time. Right. And, I've had this conversation with my wife about how stops work and what the reality could be. But then I've also had this, kind of thought that, well, given that in nearly all cases, the volatility clusters. It's not a single event like that. You would be so far out of the money that you'd hit the first circuit breaker on the SPY and still be below it in terms of out of the money. So that's part of the how do you sleep at night, I think, is thinking through those scenarios and see what makes sense for you. Finally, thinking about strategy, it's pretty common to kind of, limit your downside risk, which of course is the real risk here, with spreads. And so, from your perspective, why is spreads not a feasible option for you? Because if they were, surely you would use them.
I don't do spreads for the one DTE because, sometimes you get only 10 cents. If I were to buy back another one at 5 cents, just the transaction cost would be so expensive. You almost wipe out the entire profit opportunity if you just make 10 cents overnight. So you already spend, you only get $8.80. So $1.20 is a commission. Then you have to pay $5 and another $1.05. Right. So everything that's 5 cents is $1.05. Yeah. So from $8.80 you subtract another $6.05. So that's almost everything is gone. And so I for the one DTE, it doesn't really seem like it's really that worthwhile. So
right, okay. One thing on taxes, certainly in the fire community, it's full of do-it-yourselfers, and for many people that includes their taxes. One of the benefits of this, I believe, is that it's a very simple kind of accounting for this in taxes. Could you just describe that?
Right. So if you think about it, right, how many thousands of contracts I trade every year, and do I have to itemize them on that tax form? So this is for U.S. Taxpayers, obviously. So do I have to itemize them, right? Every single contract, when you bought it, when you sold it, would that be aligned? No, fortunately you don't. So this is. The nice thing is that all of these contracts are covered under Section 1256 of the IRS code. And the nice thing is that you get only one number at the end of the year, which is the net profit or loss. Most of the time, all of the time for me, it's the profit. And that goes on form, I think it's form 6781. So you just put that one number in there, and then 60% of that becomes long-term capital gains and 40% of that becomes short-term capital gains. And that goes into the appropriate forms on your tax return. So it's extremely easy. There's nothing to itemize. Just get one single number, and you just fill out that one extra form, and it's extremely easy to file your taxes.
Yeah, no, it's perfect. All right. Well, Karsten, I have to thank you once again for taking time away from your vacation. It sounds like a great one. I think this has been very informative, and people will benefit from it. And wish me luck, because I'm setting out on this myself.
Yeah, good luck. Yeah, it's very exciting, and I think this topic doesn't get enough publicity in the fire community. And I'm trying, and so obviously people know me for my work on the safe withdrawal rates, right? But I'm not a one-trick pony, so I have a lot of other things on my mind. This fits really well into fire, right? So
Yes.
we have some extra time. And I mean, I wouldn't want to do this when I'm 80 years old,
Right,
but
right.
we're early retired, right? We have a little bit of extra time, and it gives you some excitement, right? It's almost sometimes you watch the S&P 500 towards the market close, and it's almost like watching a basketball game, right?
Yes,
So
it
in
is.
the end,
I
and
admit I enjoy it.
so it gives you some stimulus and some intellectual and mental stimulus. I think it fits really well into the fire lifestyle. So I think I'm very happy that other people are picking this up. So good luck.
Thanks.